aware the other day, so we had discussed a lot of things about the very basic things about Forex. Okay, so we started from scratch and we discussed a lot of things. So here now we're talking about currency pairs. We said earlier that currencies are traded in pairs. And the reason why they are traded in pairs is because for you to value any asset, for you to value anything, any asset, you need to value it in terms of what you pay for it. For you to value any asset, you're going to have to value it in terms of what you pay for it. So if you have a property, they say, okay, what's this property worth? You're going to say property is worth X amount of dollars. Maybe it's worth $100,000. So $100,000 becomes the value of that property. If you don't have a value for the property, then you cannot put a value. There's no way you can quote the property, because everything in this world, everything in our world is transactional. Is something that can be valuable, But then for it to be valuable, it needs to be quoted in terms of what it will be paid, in terms of what you will pay for it. So the value of it is basically what you are going to pay for it. So that's the reason currencies are traded in pairs. So you have euro, you have USD. So the euro, like I said, is the base currency because it's the base of the basis of the transaction that you do. Whenever you buy a currency, for example, when you come to this charts today, you have USD JPY, you have GBP USD, you have gold, you have AUD USD. For every pair you trade here, every pair you trade, if you place a buy trade, you are buying the currency you are buying you are buying the base currency. If you are trading this pair for a buy, that means you're buying the base currency. If you're trading this pair for a sell, that means you're selling the base currency. Okay, so the transaction is always about the base currency. That's why it's called the base currency, because it's the basis of the transaction. It's the base currency because it is the basis of the transaction. The quote currency is what I said before, comparing. When I said you value an asset by what you pay for it, the currency on the right is basically the quote currency, and then being quote, it means that is the value that is paid. That is what is paid for it. That the currency on the right is what is used to purchase the one on the left. The currency on the right is what is used to purchase the one on the right. That's why it's called the quote currency. So for every asset pair, for every currency pair, there is a quote price. For example, this is how you see a quote price. So let's go to this chart, for example, right now. You notice that, let's say Euro USD. Okay, so Euro USD, right? So Euro USD, you notice that on the right-hand side here, there is something moving, 1.02774. 1.02774. That is the price. That is the quote price. That is what is called the quote. Okay, you can call it the quote price, but it's quote. So that quote right there it's in terms of the quote currency. So you will see this price right now, this price that is running there, which is 1.1 something that we saw just now, it's in terms of the quote currency, so that's the way it is. Then when you look at another pair, let's look at this one. Let's look at Euro USD JPY. So this USD JPY right now, you see on the side there, you see 140.675. 140.675. That's the quote. That T75, you notice that USD JPY. So USD, if you enter a buy trade now on USD JPY, it means that you are trading on the basis of the USD because it's the base currency. You are trading on the basis of the USD because it's the base currency. But the price itself, the quote price itself, which is what we're seeing on the right hand here, is actually valued in terms of the JPY. That's why you're seeing 140.68 something on the right here, if you see what I'm saying, 140.68 something. So what this is telling you is that it takes this amount here to buy $1. So this is what is paid. The JPY is what is paid for the USD. USD. Okay, the JPY value is what is paid for the USD. So that's why the JPY is what is used to quote the price of the pair. The JPY is used to quote the price of the pair. Basically, the quote currency is used to quote the price of the pair. All right, it's used to quote the price of the pair. All right. Okay, so that's what we're saying here. So these are we talked about this the other day. These are the major currencies. We have the euro, the GBP, the AUD, NZD, USD, CAD, CHF, JPY. These are the major currencies in the world. Okay, basically the major currencies. And then those currencies are the ones that also form it, because on the one hand you have the major currencies, on the other hand you have the major currency pairs. So these currency pairs, these currencies here, also pairing them together is also what makes the major currency pairs. But currencies are individual because nations are individual, okay? But then, of course, when we want to trade, we have to trade them in pairs. Okay. So let's move on. So currency pairs nicknames. Sometimes you will discover that currencies have nicknames. Now, it's not like it's such a big, it's not as if it's such a big deal. It's not like you cannot trade without this. Of course you can, but it's just as you get better in trading, there are things you need to just know. You need to know them because also when you are learning, the more as you progress, you will learn more. You want to be able to know what people are, you want to be able to know when a currency is, when they say the cable, what's the cable? When they say the fiber, what's the fiber? So you want to be able to follow the lingo, as it were, of the industry you are in. So every industry has its own lingo, right? So this is part of the lingo of the forex market. So you don't necessarily know the lingo because you need every one of it. You know it because it's important for you to know. It helps your communication and your understanding of concepts within the industry. Okay, so the USD has I'll just go straight. So the AUD USD is usually called the Aussie. Okay, the AUD USD is called the Aussie. NZD USD is called the Kiwi. Okay, Kiwi. USD CHF is called the Swizzy. USD CAD is called the Loonie. Okay, there's a reason why they are like that, but we don't really have the time to go into all that today because it's not as though it's that important. What's really important is just knowing the terms, just knowing those lingo. That's all, right? There's a reason why they are called that, but all of that is not that. We have other things that are more important towards trading than learning all of that. But basically, just know these names. Once you know the names, you're fine. GBP JPY is called the GBP, and then Euro JPY is called the UP, and Euro GBP is called the Chunel. Then Euro USD is called the fiber, and GBP USD is called the cable. Okay. Now, if you listen to financial news, most of the time you will hear some of these terms. You hear the cable, the fiber, the Loonie, the Aussie, you will hear those terms. So when you hear, you get to understand what it is that they are talking about. Okay, so that's important just to know like I said, the lingo of the industry where you are in. Okay, so if it's something you want to take note of, you can take note of them. GBP USD is called the cable. Euro USD is called the fiber. It's called fiber. Then you have the Aussie, the AUD USD is called the Aussie. NZD USD is the Kiwi. USD CHF is Swissie. USD CAD is called the Loonie. GBP JPY is Goopy. Euro JPY is the UP, and Euro GBP is the Chunel. Okay, so if you want to just take note of that, you can go ahead and take note of that. All right. So that the major currency pairs. So there are different types of currency combinations. Like I said before, when we looked at the different currency, the major currencies, we said the major currencies were the euro, the GBP, the dollar, right? The euro, the pound, the dollar, the AUD, USD, Australian dollar, the New Zealand dollar, NZD, yeah. Then you have the CAD, which is Canadian dollar. You have the CHF, which is Swiss francs. Yes. Then you have the JPY, which is the Japanese yen. These are the major currencies. Major currencies. Euro. Again, let me go by the euro. Then you have the GBP. You have the USD. You have the JPY. Right. Then you have the CHF. You have the AUD. You have the CAD, you have the NZD. So about 8 of them, they are the major currencies. But then when we come into trading, we deal with pairs. And then these currencies that are the major currencies, they also make up the major currency pairs. They are the major currencies, yet they also make up the major currency pairs. And then the reason why they make up the major currency pairs, the reason why traders trade and focus more on these pairs is because of their spread. Okay, now if you've heard of spread before or if not, spread is basically the cost of transaction for every trade that you take. So when you trade on Vantage Forex, when you try to trade on Vantage Markets, which is our broker here, when you trade on our broker here, what you get is that you pay transaction for wherever you're trading, you're going to pay a spread. The spread is basically the cost of every transaction. Okay, that's what you are charged. Okay, as we go on, you will understand where the spread comes from. Bid ask prices, we'll talk about that and then see how that calculation is done. But then basically just know right now that spread is the transaction cost that you pay for every trade that you take. So now the reason why traders concentrate more on the major currency pairs is because of the transaction cost. This spread is very small, it's very little for major currency pairs. On Vantage Forex, for example, Vantage Markets, the pairs, the spread that we charge is very, very small. In fact, on Vantage Markets is probably the broker I know of right now with the lowest spreads. Yeah, you know. So Vantage Market is one of the brokers with the lowest spreads right now. So if you are not trading on Vantage already, you want to test it out, fund your account, and then you want to place a trade and see what the spread is like. So the spread is very important for every trader because spread will eat into your profitability. Spread will eat into your profitability. So if you don't take care, or if you're not conscious of what you are paying in spread, if you're not conscious of what you are paying in spread, you will not be able to understand that you want to reduce the transaction cost you're paying. Okay. Yesterday, when the market opened at night, I was trading on 2 different brokers, and I placed a trade on one. I placed a trade on the other one. One gave me a spread of 2.8 pips. Another one gave me a spread of 18 pips. Okay, so once I placed the trade, one was in negative to the tune of 18 pips already. The other one was the other one gave me 2.8 spread of 2.8. Okay, now of course, when the market just opens, spread can be wide. I understand that, but when you're not conscious of it as a trader, you pay a lot of money. Your trade can close in loss just because the spread was very wide. So when we talk about spread, some people who may not really understand, especially if you're new, you may not understand the impact of spread. Spread can be the size of the spread of the broker can be the difference between profit and loss on the trade. Yes, many times can be the difference between profit and loss. There are people who complain, oh, my trade did not get to take profit, the market has already closed it. With some brokers, not Vantage. With some brokers, right? So, oh, my spread, they will even do a screenshot and show you, see, my price did not get there yet, it closed. The reason it closed is because the spread on that broker is very wide, very, very wide. And some of them, the spread can also be very wide, even when they are trading major pairs. That's why you want to take care when you are selecting a broker to use. So that's why I said for Vantage, Vantage is one broker with the lowest amount of spread, the lowest spread right now. So look at the spread we offer. Euro USD from 0.1 pips. That's extremely small, you know. Then USD JPY 0.5 pips, GBP 0.6 pips, AUD 0.4 pips. So you will notice that these are the major pairs that I mentioned earlier. These pairs right now, they comprise the major currencies that I talked about earlier. The 8 major currencies I just mentioned are contained here. So the reason why it's like that is how do I put it? Let me give an illustration. Now, if you are someone that sells, let's say 2 people, they sell Coca-Cola. One of them sells in volume, sells a lot. He sells in trucks and trailers and all that. And then there's this other person who sells a small retailer. Okay, he buys 2 crates and then he could sell the 2 crates in a week. But the other man who is bringing it in trucks, he sells crates and crates and crates. He could even sell a truck a day. The thing is that the one who is the wholesaler who sells a truck a day, can afford to make very, very little profit on each bottle or even on each crate. He can reduce his price, make it very little, because he will still make profit from the volume. Okay, then but when you go to the other guy who is buying crates and selling one bottle and selling in bottles, and he will not even, sometimes he doesn't sell a whole bottle, sell a whole crate in a day or 2 days. He wants to maximize profit because he knows his volume is quite low. The frequency with which he is selling is low. So because the frequency is low and the volume is moving is low, he wants to be able to make a lot of profit on one particular unit. That's the difference. That's exactly how trading major currency pairs versus trading the non-major ones. That's the difference between them. So, for example, the Euro USD is the most traded currency pair in the world. The Euro USD is the most traded currency pair in the world, followed by the USD JPY. The USD JPY is the second most traded, heavily traded currency in the world, followed by the GBP USD. The GBP USD is the third most widely traded currency pair in the world. What does that tell you? If traders are trading every day, billions and billions and trillions, not even billions, trillions of dollars go into these currency pairs. Trillions of dollars go into these currency pairs every day. Transactional, speculative. As we go on, you understand transactional and speculative. But basically, that's what it is. So much money comes into these currencies every day. You see? So that's the reason why the spreads on them can be very small. Of course, some brokers still make it large, but then for us here at Vantage, we are able to make it very small because it actually can be small. These spreads can be small because of the huge volume that these currency pairs command on a daily basis. You see? So that's the difference between these spreads. Then you come to minors. Those are majors, right? These are major pairs. Then the minor pairs, look at the minor pairs here. These minor pairs have higher spreads. Even these spreads you are seeing here right now, they are higher than these ones. They are still low with us on Vantage. Look at these spreads. On some brokers, some of these spreads command up to 10 pips. Up to 10 pips, some even more than that. Some of these pairs command more than 10 pips on some brokers, 5 pips, 7 pips on some brokers. So in Vantage is still very low, right? So, but the reason why it's higher than these ones right now, this spread, the reason why it's higher is because they have lesser volume than the major pairs. So it's just as simple. On a daily basis, the volume that goes into these pairs is trillions of dollars. These ones don't have as much volume as the major currencies. The minor currencies don't have as much volume as the major currencies. That's why their volume that's the reason why the spreads on them is a little bit higher. The same thing goes for the crosses. So the crosses are basically currency. Crosses are usually major currencies, major currencies that don't involve the US dollar. They don't have the US dollar in them. So you notice now, even these minor currencies, they are still crosses. So a cross is basically a currency pair that does not have the dollar in it. A cross is basically a currency pair that does not have the US dollar in it. So let's look at the major currencies. You will notice the major currencies have US dollar in them, always has US dollar in them. Euro USD, USD JPY, GBP USD, AUD USD. These are just a few. There's USD JPY too. Okay, USD JPY is there. There's USD CAD. There's NZD USD. You see? So these pairs that you see, there's USD CHF. Those are still major pairs, but they are not here. Now, all of them have low spreads. All of them have very low spreads. But then by the time you get to crosses are these pairs that do not have the dollar in them. They still have the major currencies in them, but they don't have the US dollar in them. So the US dollar is very powerful. The US dollar is the reserve currency of the world. And then more than 80% of transactions done in the world every day is done in the USD. Okay, it's done in the USD. That's actually why this USD, the US dollar is actually the currency that is, it's more like the Federal Reserve of the US is more like the real central bank of the world. You know, no matter how many trillions of dollars they print, it really doesn't matter that much, except for inflation, which they also have tools that they use to combat them. Okay, so that's basically what it is. So every other pair that does not have USD in them is basically what you call crosses. Then you have the ones we call exotics. You have the one we call exotics. Okay, so you have the major pairs. You have the major pairs, major currencies, the major currency pairs. Then you have the minor currency pairs, the minor currency pairs. Then you have the crosses, the currency crosses. You call them crosses, or you call them currency crosses. You have then the exotics. So the exotics is basically currency pairs that contain one of the currencies of an emerging market. Emerging market, for example, the currency from Turkey, currency from South Africa, South African rand, you know, the Turkish lira. I think that's what this is. TRY is Turkish lira. So these emerging markets, these markets that are not major, but they are emerging. They are like second level currencies, second level economies. You know, those pairs, the currencies of those countries combined with one major pair is what you call the exotics. See, so here now you have euro, then you have TRY. This TRY is the Turkish lira. So this Turkish lira, by the time you combine it with euro, that pair is an exotic pair. Then here now you have CAD and SGD. This SGD is the Singaporean dollar. So you have Canadian dollar paired with the Singaporean dollar. So when that pair now is an exotic pair. Why is it an exotic pair? The euro, for the first one, the euro is a major currency. But the Turkish lira is not a major currency, it's an emerging market currency. The CAD, on this other hand, on this other currency, CAD is a major currency, but the Singapore is not a major currency, a major economy, is in an emerging economy. Even though to a very large extent is developed, but it's not among the class of, it's not among the class of 8 currencies and 8 economies we talked about earlier. The eight economies we talked about earlier is not there. So it's still categorized as an emerging economy and emerging currency. So that's what gives you the exotics. And these exotics, one characteristic they have is that they are not very heavily traded on a daily basis. South African rand is also in this category. So when you say by the time you have USD South African rand, okay, that currency is also an exotic. So the thing with them is that you will usually see that these currencies make major moves on a daily basis. But since they are not heavily traded, they are not as heavily traded as the major currency pairs, what you discover is that they have a huge amount of pips, of spreads. Now, why you are seeing 0.1 spread here, 0.4, 0.6, over here you come to minus, you are seeing 2.1, then you come to crosses, you are seeing 3.7, 3.1, 2.7. When you come to exotics, you can be seeing 30 pips as spread, 30 pips, sometimes 35 pips. So the point here is this: think about pips, think about spread as the cost of transaction, the cost you are paying per transaction. If you have two players, for example, you want to send money, and then there are two service providers you want to use. One of them charge a whole lot, one charge 10%, the other one charges 1.9%. One charges 10%, the other one charges maybe 1.9%. It's sensible that you want to go with the one that charges 1.9%. That's just what it is. Okay, so it doesn't even matter whether the one that charges 10% is faster. Most of the time, for that particular service, speed may not be something that you are looking for. It may not be what you're looking for. First of all, you're looking to, because if you're trying to move money, one of the things is that if you are spending a lot of money moving money, then it's costing you a lot of money. You see, so if that's business, you want to be able to reduce your costs. Okay, so when it comes to speed, you can apply speed when it comes to other things, but when it comes to money and financial transactions, you want to be able to use that to reduce cost. Okay, so the thing with these exotics is that they are very expensive to trade, very expensive. Sometimes the profit that you will make on a trade is not enough for you to pay for the spread. So what's not the point of entering that trade? If you're going to target 30 pips on a trade, and then the spread on that trade is 35 pips, what are you not going to benefit from making that trade? It doesn't make sense. You don't benefit anything from making that trade, right? So that's the reason why we want to focus more on trading the major currencies. These major currencies are the ones that most traders want to trade because of the transaction cost, which is the spread of trading these currencies. So as new traders too, as you're coming into this market, you want to be able to understand that, hey, where I want to be staying, where I want to stay more is where other major traders are trading. Institutional traders, when they are trading today, they're not going to look for exotic pairs to trade. Because if they trade exotic pairs, they'll literally destroy those currencies, because they are moving billions of dollars and sometimes trillions of dollars. The economies will not even survive. And they also don't benefit anything because they can get their funds tracked. So most of their money, these currencies are very liquid. These currency pairs are very liquid. Liquidity means that you can move in just like water, right? You think about liquid flow. So the currencies flow very much. If you want to buy, you buy. You want to sell, you sell. That's why when you're trading, you don't ask. We know that in trading, you are either buying or selling. So when you come on the chart, you don't say, well, who am I selling to? Who am I buying from? No, the system takes care of that because of liquidity. But do you know that there are some assets you are trading? You will place a buy, trade, you'll be waiting for somebody to pick the buy. You'll be waiting for someone else to pick the buy. It happens most of the time, most of the places where it happens now are usually small stocks, small time stocks and cryptocurrencies. I think for those who are listening on this call, cryptocurrency may appeal to you faster. So you place a trade on crypto and you're waiting. In some cases, if the currency is not very big, it's not Bitcoin, it's not Ethereum and all that, it's the smaller cryptocurrency you're dealing with. You place a buy trade and you're waiting for someone to pick up your buy trade. And the buy trade will be looking at you. But in the forex market, it's not like that. When you enter a trade, you enter buy, it buys. You enter sell, you close the trade, it sells. You enter sell, it sells. You enter buy, it buys. Why? Because of liquidity. Because of liquidity. So that's why you want to stick with these currency pairs right here. Right? You want to stick to the major pairs when you are trading. Okay. So let's proceed. Okay. So now, for every trade you are doing, there are two goals. There are two actions, three actions basically. The third one is something you don't get to hear of much, but I'll mention it here. Now, two major things you want to do. You're either buying or selling. When you buy, that's what is called going long. When you buy, that's what it's called going long. It's called being bullish. When you hear bullish, when you hear long, all that means you are buying. When you hear short or sell, short, those means that you are selling. So short means sell. Bearish means sell as well. So when you hear bear and bull, the bull is for buy, the bear is for sell. Okay, so whenever you hear short is basically to sell. When you're shorting a particular asset, you are selling that asset. When you are shorting a particular asset, you are selling that asset. And when you are long a particular asset, you are buying that asset. That means you have a perception or a perspective that this asset is going to be rising in value. That's why you are long. That's why you are buying. You see? So when you think an asset is going to drop, that's when you want to sell. So when you make a buy trade, your perception is that the asset is going to go up in value. So if you come to Euro USD, for example, let's do a little illustration here. So if you go to Euro USD, so you go to Euro USD and you are making a buy trade. You're making a buy trade. So a buy trade means that you believe that this currency that you're buying is going to appreciate, which means that it's going to move from a lower value to a higher value. It's going to move from a lower value to a higher value. Okay. So you know that this is where the price is. You know you are buying because you expect the price to appreciate to a higher value. That's why you buy. That's why you buy. Then if it's for a sell, you are selling because you believe that this asset is going to drop to a lower value, drop to a lower point. Now you have price at this point. You believe that price is going to drop here for you to make a profit. So you are going to make a sell because you believe that the price is going to drop. It's only in the forex market that you can actually buy and sell. Now, if you're in traditional business, in traditional markets, all you can only do is you buy low and you sell high. If you buy low, you sell high. Yes, that is what we're doing here still. You buy low, you sell high. On one hand, that's what we're doing forex too. When you buy, that's still the concept. The concept is buy low, sell high. When you make an analysis and you see, oh, the price is going to go up, then you make a buy. So when you make a buy, when that price appreciates, what happens is that you make profits. Okay. But on the flip side of that, when you see that an asset is about to fall, the currency pair is about to drop in price, because we know that price is always going up and coming down, right? It goes up now, it comes down. You can see different candles, different candles here. So you see the red candle, you see the green candle. The green candle means that price went up in that period of time. That's a time frame. In this case, it's 4 hours. 4 hours. Okay, we'll talk about that when we get there. But for every candle you are seeing here, all these are called candlesticks. For every candlestick you're seeing, everywhere you see green, it means that price moved up from a lower point to a higher point in that period of time. Anywhere you see red, it means that price came from a higher point to a lower point in that period of time. So the market is denoting these movements to the market is color coding, as it were, these movements to us and telling us that, oh, this thing bought in this period, this thing sold in this period. So if you notice now, let's say price is somewhere and you expect that price is going to be buying, you make a buy. Price is going to go from a lower point to a higher point, you make a buy. When that happens, you make a profit. So when your price is at a certain point and you expect that, oh, it's going to move from this high level to a lower level, that's when you make a sell. And that's the only thing, that's what you can do only because you are in the forex market. You cannot do it in real estate. You can't do it in any other business. You can't sell when you see that price is going to buy and when the price is going to drop and make a profit. For example, if you bought dollars now, if you bought dollars at, some people bought dollars at 900, and for something in Nigeria, I'm talking about Nigeria, probably there's some other people who are not from Nigeria here, but in Nigeria, some people bought dollars some weeks ago for 910. Eventually, because of certain things, I think it dropped to about 700 or so a week ago or thereabout, I think last week. That dollar you bought then at 910, that is now selling at seven something. There's no way, even if you saw that happening that time, you saw that it was going to happen, there was no way you were going to profit from that, because you already have your 910 naira per dollar in your hands or in the bank. There's no way you're going to profit from that. But if you were trading in the forex market, in the electronic forex market that will give you that market gives you this platform, and you are trading here, you can take advantage. You can see, okay, this thing is about to drop in value from 910 to 750. You make a sell trade there, and then when that drop happens, you will be the one making profit on that. Okay, that's exactly what long and short. That's what it's all about. Okay, and there's something else I said I was going to mention, which is not here, which is something that you will understand more as you trade, is the point of waiting. So you are either buying or you are selling or you are waiting. Waiting is when you have on the market, or you have to this trade. Like for example, we sent out several trades this morning, like what we do every day. Now, if you have that trade running right now, you will notice that many of the trades are saying pending orders, buy limit, sell limit. Those trades now are not active yet. Many of them are not active yet. Okay, so we've done a certain analysis, and we looked at the market and we said, okay, at a certain point, the market is going to be dropping or is going to be selling. So we put a sell limit there. Set your sell limit. For those who don't know how to set sell limit, we are going to have a class for that also, where we'll show you how to set pending orders, all kinds of orders. There are several orders. Stop orders, pending, buy limit, sell limit, buy stop, sell stop, market orders, and so on and so forth. You know, even stop losses are orders, take profits are orders. They are all different kinds of orders in the market. Okay, so these orders are basically a command to the market, telling the market that when you get to so and so point, please execute this trade for me. Okay, if you said they take profit, it means that, oh, when market gets to this point, please close this trade for me in profit. There are all different kinds of orders in the market. We'll get there, you'll understand it better. Okay, so in that period of time, you are waiting for the market to play out. So it's not like every time you carry your computer or your phone and you go on the platform, there's always a trade to take at every moment. No, of course there is a trade coming. Now a trade could be activating at the exact time that you are opening your chart. It can coincidentally happen. But then most of the time you are going to have to analyze the market or follow an analysis of the market of something that is about to happen. That's what we do in the market. When we say analysis, we are analyzing the market as we're analyzing the market and looking into the market for something that is likely to happen in the future, not necessarily in the current. So we are planning and we are setting track, as it were, for price. And we say, hey, if price does this, this is what we're going to do. We're going to buy. If price does this, then we're going to sell. All that is still in anticipation. We are still planning. We are not entering the market yet. We'll have to wait. If I say, okay, we want price to get to this point before I buy, I want to get to this point before I sell, we have to wait for that to happen before we take action. So that's something. The reason I said I mentioned is because most traders do not really understand that. You just think, oh, I get into the market. There is a point where you set a trade and you wait for the trade to play out. Okay. All right. So now we'll talk a little bit about lot sizes and leverage. And I'll be explaining some things here so that we can understand it better. I'll write some things on the screen so that you understand it better. lot size and leverage. Okay. So what's lot size and leverage? Now, leverage is the ability to power up your trading capital. So now, usually you could come into the market because the market is the platform that where you trade. Look at the platform where you trade has what you call standard lots. The platform where we trade has what we call standard lots, and these lots we are talking about when you want to trade on MT4 or MT5, you will see lots there. They will tell you volume. You will see it as volume. Now, volume means that the amount of money you want to, the size of the trade you want to take. That's what it means. It's just like two people. Let me use Coca-Cola again. One person does transaction of 100 million a month because he has that amount of money. So he has trucks, he has all kinds of things. He buys that amount of money of Coca-Cola for distribution in a month, 100 million. The other person doesn't have that much capital. So he does maybe 10 million, or maybe he does 5 million, maybe he does 1 million. Why? The difference is the size of the capital. So if you go to Coca-Cola and you say, I want to be a distributor, it depends on the amount of money you have. They will not judge you. They won't say, oh, you are not this, you are not that. No. How much money, how much volume are you looking at doing? That's what they are concerned about. How much volume are you looking at doing? You see? So that's what lot size is in the market. So the lot size, the size of the lot that you can use depends on the capital that you have. The lot size you can use depends on the capital that you have. So there are three different kinds of lots. I'll copy this and put it there so that I will explain it better. So there are three different types of lots. So there is the standard lot, there is the mini lot, there is a micro lot. So the micro lot is what you are going to see on the chart as 0.01 all the way to 0.09. That's the micro lot. Micro lot is what that is, 0.01 to 0.09. The minimum is 0.01 to 0.09. That's the minimum loss that you can use. So it's basically the volume that you have. So that's the kind of lot size you want to use if you have a $100 account, you have a $50 account. The minimum to open an account on Vantage is $50. So if you have a $50 account, this is where you want to keep your lot size. 0.01, 0.02, that's where you want to keep your lot size because of your capital. Your capital is not much. So also, another thing you realize is if you're doing a transaction of 100 million naira a month with Coca-Cola, for example, okay? I don't know why I don't want to use Coca-Cola. I don't even like Coca-Cola. But I think it's really easy, right? So now, when you are doing 100 million naira a month in transaction with Coca-Cola, and you were to make the profit that you're going to make is going to definitely be more than someone who's doing 5 million. Definitely, the person who's doing 100 million may make more than 5 million in profit. Meanwhile, that is the volume, that is the amount someone else has to do the business. So it's the same thing when you are moving from one loss to the other. When you're using 0.01 to 0.09, the micro lots, your potential profits are going to be smaller because your capital is smaller. Your potential profits are going to be smaller because your capital is smaller. Okay, so now you have then a mini lot. The mini lot is where you get to 0.1 to 0.99. That's mini lots. So for mini lots, this one is the next level. It's higher than the micro lots. So it's like 10 times more than the micro lots. So in this case, your capital again is 10, it has to be maybe like 10 times more for you to maintain an amount of risk in the market. So that's the lot size. Because this lot size, the reason I'm putting these numbers is because these numbers is what you're going to find on your charts. When you come to volume, if you open MT4 right now, I don't have MT4 open here, I would have shown us. Right? When you go to volume, what you're going to see, you won't see micro or mini. You won't even see 1,000, 10,000, 100,000. That's not what you're going to see. There are some other platforms where you see those numbers. Yes, there are some other software trading platforms where you see numbers. But mostly on MT4 and MT5, which we offer, which we Advantage Markets, which we offer, we give you the numbers in these lot sizes that are in numbers 0.1, 0.01, and all that. That's how we do it. Okay. So, and that's what you will see on all MT4 platforms and on MT5 platforms. That's what you're going to see, whether it's for web, whether it's for web, whether it's for the computer or phone or laptop. That's what you're going to see. Then standard lot is 1.0, 1.0, all the way to 1,000, okay, or 100. Okay, so that's also let me stay there. So 1.0 all the way to 100 or so. So that's the standard lot. Standard lot. So standard lot requires that you have a certain amount of capital in the market for you to be able to use a standard lot. But definitely your profit is going to be higher. It's still more like what I illustrated with the Coca-Cola concept. Right? So the more money you have, the more the size of the lot that you are able to use. Okay. But then before you do all these things, like we're discussing leverage earlier, we said leverage is the ability to power up your capital. So what is the relationship between your capital and these lot sizes I'm discussing? I'm sure that's the question someone will be asking. What's the relationship between capital and this lot size? So how do I even know the amount of money I need to use per lot size? Okay, so if I'm going to use one standard lot because I know every pip is going to give me $10, how much capital do I need to have? So all that is very important as we go on. That's where leverage comes in. Okay, so normally when we say standard lots is 100,000 units, which is $100,000 is what it will take you to trade one standard lot normally, right? Then 10,000, that's the reason for these units you are seeing here, is usually dollars. These 10,000 units for mini lots that's what you would have needed. That's what you would have needed. Take note, I said would have needed. That's what you would have needed in order to trade one mini lot size. And $1,000 is what you would have needed to trade a micro lot size. But because of leverage the Advantage Market gives you, then you don't need that amount of money to trade. So what you just need to do is take advantage of the leverage that we give you. So on Vantage FX, Vantage Forex right now, Vantage Markets right now, you can get leverage of up to 1 to 500. What this means is what I explained earlier when I said the ability to power up your trading capital. The ability to power out your trading capital means that you can deposit a small amount called margin. You can deposit a small amount called margin. Amount you deposit. Margin is your capital. Your capital is called margin. So the amount of money, when you create an account now, you fund it with $100, or you have always $1,000, $500. That is your margin. That's what is called margin. But then, in order for you to be able to take more advantage, a larger advantage of what the market offers, you want to take advantage of the leverage. That's where Vantage gives you a leverage of up to 1 to 500. You don't have to use all that leverage. It just means that you are able to trade like someone who has a larger amount, a larger capital. So let's say you funded your account with $1,000. You funded your account. Your margin is $1,000. Or you can trade this $1,000 as if it is $10,000. So you trade it as if it is $10,000. Okay, why are you able to do that? Because of leverage. Leverage allows you to trade your capital as though it is more. So in this case now, you can see that the relationship between your margin and this amount of money you're trading is 10. You have $1,000 in the account. Now you are able to trade as though you have 10,000. So that's a leverage of 1 to 10. That's a leverage of 1 to 10. So that's 1 to 10. So when we say we give you a leverage of 1 to 500, it doesn't mean you have to use the entire 500. It just means that you have the allowance. Okay, you have such an allowance, but doesn't mean you have to use everything. Because leverage also you have to understand, because for you to use leverage, you have to become much better, be able to understand the market better. Because leverage is a two-edged sword. Okay, the leverage is a two-edged sword. The way it amplifies your profits. So you imagine this now: when you trade with $1,000 and you trading like you have 10,000, the profit margin is going to be more, because you are trading as if you have 10,000. The profit will be more. But also, think about it: if you enter a trade that goes against you, the losses will be more. So the way trading works is that trading is not a place where you don't make losses at all. It's a place where you make more wins than losses. Let's say you have 10 trades and 7 of those trades are winning trades and 3 of them are losing trades. You are in overall profit. That's exactly how trading works. Okay. So we're going to wrap up this class right now. We're going to continue the class from here. My next class, we should be on Wednesday. So I'll be expecting to see you guys again in the class on Wednesday. So we're going to continue this and we're going to be able to delve deep. I'm going to show you guys how to calculate lots, how you should know what to risk per trade, what's risk per trade, what's stop loss. All of those things is the next level we're going to be going into so we can understand it better, right? So I'll see you guys on the next class. Okay, and this class is being recorded. It's going to be made available to you.